Well, welcome back to all of our VITA volunteers. My name's Jim Simpson, and on behalf of the Central Arizona VITA Network, the City of Phoenix, and Masters of Coin, we're going to continue on with our presentations to help our VITA volunteers get certified. In our last session, we started talking about income, and we covered W-2 income, 1099s, interest and dividends. We talked about Schedule C business income. So now let's take a look at what we're going to start covering in session 3. And again, for session 3, we'll split this up into two videos. So it won't. But here's our agenda for session 3 right here. We're going to start by just doing kind of a homework review. I'd ask you to start entering in the tax returns in TaxSlayer, the basic information in the W-2s and 1099s. And then I also ask you to go through those first 6 scenarios that don't require a tax return and at least answer the questions that we've covered so far. So I'm going to kind of go over those with you. Then we're going to jump back into income again, and we're going to talk about retirement income. We'll talk about some state-specific exclusions, mainly in Arizona, but if you're from another state, you may want to look at your state's exclusions for that too. We'll probably finish the first video with income from capital gains. We'll start the second video with other types of income, like from K-1s and unemployment and that stuff. And then there's many adjustments to income. Remember our tax formula? Started with income, less adjustments to income that got you to adjusted gross income. We're going to talk about the adjustments in there, and then we'll give you some more homework to do before we start session 4. So let's get started kind of reviewing the test booklet. Okay, so let me share that for you. Now remember, we're working in 2 test booklets here. Okay, when I'm showing the examples in TaxSlayer or in Practice Lab, I'm using the information from our 2024, right? But you should be looking at the 2025 booklet right now for what we're going to do now. We're going to overlook some of these test questions, and what I'm going to do is I'm going to try to tell you where I would go look for some of the answers for it, just to kind of help you along with some of this. So again, we're looking at the advanced test, and I believe that those start on let's see here, page 75. So let's scroll on down there to page 75. Okay, so here we have the advanced course scenarios and test questions. So the first advanced scenario gave you some facts here. It looks like Joy's husband Peter moved out of their home in March of 23. Joy has had no contact with Peter since he moved out. Joy and Peter are not legally separated. So, okay, right there, I think it's going to probably ask me about filing status. And when it does, I'm going to go look at my 4012. And in that section, remember there was that flow chart there was those charts A, B, and C that talked about filing status. I would tell you to go look there. The second thing says Joy has 1 child, Valerie, age 10. She will claim Valerie as a dependent on her 2025 tax return. Okay, nothing we have to do with that. Joy is 31. She earned $46,000 in wages and $50 of interest. She had lottery winnings of $2,000 reported on Form W-2G. Joy paid all the cost of keeping up her home. She provided over half the support for Valerie. Remember, those are tests for dependents, right? We would go look at. And they all have social security numbers and lived in the US all year. So what's their filing, what's her filing status? So again, you want to go into your 4012 and look in, I think it's section B, talks about filing status. And there's some really good tests there. So shouldn't have any problem with that. Okay. Who qualifies to claim the earned income credit, also known as the earned income tax credit for Valerie? Now, we haven't talked about tax credits yet. So don't try to answer this yet till we get to that. Now it says Joy is not required to report her lottery winnings as income on her federal tax return. Now, what they're trying to ask you about here is, hey, do you know what is income and what is not income? Remember we talked about that in the last section, and I told you, go look at those charts in tab D of the 4012. I had pretty much told you, ignore the one that says what income is. Go look at everything as income except what's on that second chart, what's not taxable. And so you want to go kind of look and see if lottery tax winnings were taxable. So that was advanced scenario one. So what's in two here? Matt and Megan are married, filing a joint return. They're US citizens, have social security numbers, resided in the US. They've got two children, age 8 and 17. They're US citizens and have social security numbers. Matt earned $33,000 in wages. Megan earned $21,000. In order to work, they paid $2,000 to their son Jack to care for Janice, and they provided all the support for their two children. So now the first question is going to ask you about the child tax credit. We haven't talked about tax credit, so just put this on hold for a minute, right? Same thing down here about dependent care credit. We haven't talked about that yet. Okay, advanced scenario three. So first of all, let's go skip down to the questions before I read all of this, the fact pattern here. Because the first question asks about whether she's eligible to contribute to her HSA. That's a health savings account. And we haven't covered that yet. Same thing here, we haven't covered HSA yet. Okay, and this question too is about HSAs. So we don't, really not much you could have done there. How about advanced scenario four? So right here, okay, so now this question's asking about dependents, claiming dependents, and we have covered that. So let's go look at the facts. Alexa, age 62, is single. She owns her own home, provided all the costs for keeping up her home for the entire year. Her only income was $48,000. Amy, age 24, is Lillian's daughter. No, it says Amy, age 24, and her daughter Lillian live with Amy's mother. So we got grandma, daughter, and grandchild, right? All living in the same house. And it says that they've lived with Amy's mother since Amy separated from her spouse in May of 24. Okay, so remember, there's all those rules about claiming dependents and how long the dependents lived with you and all of that. So we got to keep track of this here. Okay. Amy's only income for 2025, and also it's hard to keep track of who's grandma, who's daughter, and who's grandchild, right? Looks like Amy's the daughter. Okay. And so she had 24,000 in wages. Amy provided over half of her own support. There's a clue about whether grandma can claim Amy or not, right? Lillian, so I guess that's the granddaughter, did not provide more than half of her own support. Again, those are rules to determine who can claim the dependent. Now it says Amy will not file a joint return with her spouse. Okay? And then it says all the individuals live there. Now, I will warn you, this is a hard question. Okay? You need to go look in the 4012, and you need to look at that flow chart about who can who can claim whom as a dependent, because you may find it, and here's what you need to look at is go through the test for, it says what we're looking at here is who can claim Lillian. And it's quite possible that both could claim Lillian. And I will give you a little clue. Don't just stop at the first answer. Read all of the answers. And in fact, there's a section below there. If you find that both could possibly claim Lillian, then you got to go look at the tiebreaker rules. And again, I'm going to warn you, don't just stop at the first tiebreaker rule. Go read that whole section, because I think in that section in the 4012 will give you a good clue to answering this question. Okay. And then again, it's asking about the earned income credit, which we haven't covered yet. So just save that, put that on hold for a while. So here we have scenario 5, Julia Jacobs. Let's go look at the test questions. So it's asking, can they deduct mortgage insurance premiums? We haven't covered deductions yet, so just wait about that. And again, this is about deductions. We haven't covered deductions, so just wait on that. Okay, advanced scenario 6. So what are the questions here? They're asking about the American Opportunity Credit. We haven't covered it yet. And then they're also asking about whether he would owe an additional tax on his IRA distribution, and we haven't covered that yet. Okay. I think we're going to cover that in today's video. Okay. Advanced scenario 7, all I've really asked you to do with these is to go in and put in the basic information and then enter those forms that we've talked about, such as hold on a second here, I'll scroll down, such as W-2s, you should have entered that. We haven't covered this one. We're going to cover this today, 1099-Rs. We're going to cover Social Security today. I think we covered cancellation of debt, so you should have been able to enter that form. Tuition statement is about credits, so we haven't come to that yet. So same thing with 8 and 9 is just enter in the forms we've talked about, okay? Okay, so there's kind of a review of our homework. Let's get back into our presentation here, and we'll start going through that. So here are the forms we're going to start with. These are retirement. These are forms for IRAs, pensions, and annuities right here. Now, here's the good news. In my 35 years of working taxes, I don't think I've even ever seen a railroad retirement form or a civil service annuity or a civil service survivor's annuity. They do exist, and there are ways to input them into TaxSlayer, but our focus today is going to be on 1099-Rs and SSA 1099s. These are the forms that Social Security is reported on, and we see lots of these. So that's where our focus is going to be today. So here's the income screen in TaxSlayer, and you're going to, when you do go to input these, and I'll show you, we'll go input a couple in TaxSlayer later on. You're going to go into this screen right here that says distributions from pensions, annuities, retirement, IRAs, Social Security, etc. And when you click on that, then you're going to have the ability here. We're going to focus on these two, adding a 1099-R and then Social Security benefits. We're not really going to worry about this one. And then non-taxable distributions, anything that qualifies under this is going to be out of scope for the VITA program. Those get kind of complicated. Okay. So here's what a Social Security statement looks like. Now, usually there's kind of a pink header at the top of it. You know, this portion is in pink. And the reason I tell you that is because folks will come in, the first thing that they come into, and we ask them if they have a Social Security card. And they say, oh, well, no, I haven't carried that for years. Well, if they appear to be old enough, we're going to say, well, are you collecting Social Security? Well, yeah, and then they start throwing out all these papers there. Look for the one with the pink header because, see, it will have the Social Security number on it. And we can accept this form as proof of their Social Security. So on this form is pretty simple. The one thing that could complicate is it'll say box 3, benefits paid in 2024. Ignore that because sometimes there's deductions right in here. We want to focus on box 5. That's the income we're going to report here for Social Security. Over here in box 3, it's going to also give us some information about Medicare premiums. And in this situation, and this could be common, although it says 0 here, but there's most of them will have Medicare Part B premiums deducted from their benefits. Not all, okay? But you also need to look and see if they have Part D Medicare. And if they do, add these two together. And you'll see in a minute where we input those, which is on this screen right here. So this is a screen in TaxSlayer when you click on Social Security, SSA 1099. Here you see you'll have two sections, one for the taxpayer and one for the spouse. So here, and it tells you right here, taxpayer Social Security benefit, generally box 5. Just put in what's in box 5. And then it'll say if there was withholding tax. Let me go back up there because see here in box 6. Now we don't often see withholding tax, but occasionally you do, and it's easily missed. So be sure that we don't miss that. Okay. And then down here, it'll say taxpayers' Medicare premiums. Add those two together if there are two, and put it in here. The only thing that happens here is if they do itemized deductions, TaxSlayer will count this as a Medicare expense, as a medical expense for them. Okay, taxability of Social Security. Okay, this year we're going to get a lot of questions. I think we're going to get a lot of questions. I'm sure you've heard in the press, and if you get Social Security like I do, I got a letter from the Social Security Administration, and it was saying under the new Big Beautiful Bill Act, or I forget what they call it, but hey, Social Security isn't taxable anymore. Well, yes, it is. Okay. What they did is they gave an additional $6,000 exemption to help offset the Social Security tax. Nothing changed about the taxability of Social Security. So when is it taxable? Well, first of all, if your only income is Social Security, it's never taxable. And we get a lot of senior citizens and things like that. In fact, they're told that they don't even have to file a return because their Social Security is not taxable, and maybe their income, what little income they have, is below the standard deduction. That's true. I don't think that's a very good idea. We should file it for them for a couple of reasons. They might be entitled to some state credits, and we can protect their identity. Make sure nobody uses their Social Security number to file a return. But let's talk about, are their benefits taxable? The only way they would become taxable is if they have other income. And the other income depends on your filing status and, basically your filing status. So if you're married filing jointly and you've got less than $32,000 of other income, you maybe have a part-time job, or you get a distribution from a retirement account or something like that. But as long as that income's under 32,000, your Social Security is not taxable. But then it starts to become taxable. 50% becomes taxable then, and the more income you make, with a higher percentage of your Social Security is taxable, until it caps out at 85%. The maximum is 85% of your Social Security. I forget where that happens, like it's somewhere around 40,000 for married filing jointly. The good news is TaxSlayer will calculate it. And so what we need to be prepared for this year is a lot of folks will come in and say, well, I read in the paper that it's not taxable anymore. And we have to explain that, look, they're going to get an extra $6,000 if they're over 65. And careful, when I just said that, I realized they could be collecting Social Security at 62 and they won't get that $6,000 extra deduction. Okay, so lots of things we're going to have to deal with here, and we'll talk more about that $6,000 later. Okay. What I want to talk about here is, well, if they say, well, how does it figure that out? I mean, I didn't have to pay that much tax last year. And the good news is that TaxSlayer, after we finish the return, it's going to print out a calculation of how it was calculated. As I said, it's a sliding scale that comes between 50 and 85% once your income reaches 32,000 and then goes up to some other point up there. So if you're curious about the calculation and you're having trouble sleeping some night, grab one of those tax returns that's got the worksheet on it and start working through that worksheet. It'll put you right out to sleep. Okay. Okay. Okay, let's talk about IRAs. And what's the difference between a Roth IRA and a traditional IRA? Okay, so Roth IRA distributions are generally tax-free because when they went into the IRA, they didn't get a deduction for it. It was after-tax money that went into that. But then it grows and grows and grows, and then everything that comes out is free of tax. So all the earnings that happened in that account, not only do their distributions come out tax-free, but the earnings come out tax-free. So it can be a pretty good deal. A traditional IRA is different because when you put that money into the IRA, you get a tax deduction. You don't have to pay income tax on it. But then it sits there and grows and grows and grows. And then when you start taking distributions out of it, it's 100% taxable. So that's kind of the basic difference on it. Now, there's another wrinkle here too, that if taxpayers take a distribution before they're age 59 and a half, they're going to have to pay a 10% penalty, an early withdrawal penalty, unless an exception applies. And we'll talk about those exceptions in a minute. Okay. That 10% additional tax with a Roth IRA, it gets a little bit more complicated because if you take out money out of the Roth IRA before you're 59 and a half, your distributions, you've already paid tax on some of the money that went in there. So you can take that out without penalty. But then the portion that's the earnings, you're going to have to pay the penalty on. Okay, unless an exception applies. And often we find exceptions apply. Okay. So now what's the difference between a 401k and an IRA? And again, I'm going to call them traditional 401ks because we're finding now over the last few years that employers will offer both a Roth 401k and a traditional 401k. But a 401k and an IRA, they're pretty similar, meaning the money that you put into the regular 401k, you don't have to pay taxes on. It grows and grows and grows. And then when you start taking it out, it's 100% taxable. Okay, the big difference between a 401k and a Roth IRA, okay, is look at the money that you can put into an employer-sponsored IRA. You know, you can put up to, well, 23,500 a year, or if you're over 50, goes to 31,000. And look at my little footnote down here. This year, the OBBA, the One Big Beautiful Bill Act, that gave you, if you're between age 60 and 64, you can put in another 4,000. So that would put you up to, I don't know, like 35,000 that you can put in. Now, IRAs have lower contribution limits. It's $7,000 a year or $8,000 a year if you're over 50 plus. Those are called catch-up contributions. Once you're over age 50, they're called catch-up contributions. The traditional IRA will have income limits. Okay, so you got to be careful of that. Whereas your work-sponsored plan doesn't have any income limits. And I mean, this is, most of you are aware of this, but it's worth pointing out. The employer will sometimes match some of your contributions. That's free money. You know, you should always put in enough to get the employer match for it. Okay. Other similarities here too, and it's again, okay, this is if you have a traditional 401k or IRA, the money, I've already said this, the money you put in is not taxed. You know, this would be if you're putting money into a regular traditional IRA, you get a tax deduction. It's not taxed. And then you pay taxes on the money that you take out on 100%, both your contributions and your earnings. With the Roth, the money you put in has already been taxed. You don't pay tax on any of the money you take out during retirement. Now remember, you have to be 59 and a half. You've already paid tax on your contributions. And here's the good part of this. You never have to pay tax on the earnings. That makes it pretty good. The only downside, you might say, well, why would I ever consider a traditional IRA? Well, here's the reason. Is because the money that you would have paid in taxes that you don't have to pay tax on when you put into an IRA, that gets to grow. And sometimes if that sits in there 20 or 30 years, boy, the earnings on that can maybe wipe out the benefit that you got before. There's a break-even point, but I tend to suggest to folks, have a balance of both, right? for many other reasons, but that's beyond the scope of this discussion. So, okay. Now there's something called required minimum distributions. This sometimes surprises some of our folks, our senior citizens come in. Nobody really told them about this and they didn't realize, and they heard about RMDs and didn't realize, and then they turn 73 and their IRA trustee says, oh, you got to start taking money out of this. And wow, it's based on their age. They don't have to start until you're 73, but then it's based on your life expectancy. So if you've got a lot of money built in there, it's going to look at your life expectancy. And so like at 73, if they think you're going to live to be 88, they want you to take out enough money to where you draw it down by 88. And that can be a big chunk of money sometimes. Kind of surprising. Here's another one of those advantages to Roth. There is no required minimum distribution out of a Roth. So maybe if you want to be passing on money to your kids or something like that, that having it in a Roth is probably a good idea. Okay, here we had talked about an early distribution penalty. This is about premature distributions, meaning distributions before age 59 and a half. Now, usually they're taxable. Maybe not for a Roth, but even if you take money out of a Roth before 59 and a half, the earnings are taxable. Okay? Not only that, they can be subject to a 10% early withdrawal penalty. And here's something, when we look at these 1099-Rs, you're going to see that there's codes in box 7. And if that code is 1, the distribution is probably subject to that additional tax penalty, that 10% penalty. Okay. Box 1 says normal distribution, no known exception. Okay. If a distribution code on box 7 of the 1099-R is 2, 3, or 4, that distribution is probably not subject to the additional tax. You may have to pay tax on it. Okay. In fact, likely you will. Okay. You'll have to pay income tax, depending on how it was set up. But you won't have to pay the 10% penalty. Here's an example of that 10% penalty. So Eric is 33 years old. While he was unemployed, he cashed in his 401k savings from his previous employer, used the money to pay off debt. He does not qualify for any exception to the additional tax on early distributions. There are a series of exceptions, and we're going to go over those. But in this case, he doesn't qualify. He received a Form 1099-R with a gross distribution in box 1 of $2,500 and a distribution code of 1 in box 7. 1 will say normal distribution, no known exception applies. Okay. You might be asking me, well, where do I find those codes? Well, on the back of the 1099-R in tiny, tiny, tiny print, it'll say it. If you don't have a 10 times magnifying glass, you can go into publication 4012 in section D, I think it's like page 47, will give you all the code explanations for there too. But back to there, what is the amount of additional tax on this $2,500 early withdrawal? Well, the answer is $250. He has to pay $250. He has to pay regular income tax on it plus a $250 penalty. Okay, so where do you enter these in TaxSlayer? And we'll go in and show you in TaxSlayer using one of our examples. But here you'll go into that screen, add or edit a 1099-R. Remember that starts with, under the left-hand side, it says federal, and then the income screen, and then it says, I think, retirement income. Right? I showed you that earlier. Okay, so you've put in this screen right here is saying, after you've put in all of that stuff, it says, hey, your distribution code in box 7 indicates your 1099-R is an early distribution. In other words, TaxSlayer knows you weren't 59 and a half when you took it out. So it's warning you that there's a penalty here, and it says, what type of plan did you receive the distribution from? Okay, it's almost always going to be retirement plan. And then it says here there are certain exceptions for which IRS will allow you to make an early withdrawal and not have to pay the appropriate penalty. Not sure if your withdrawal qualifies? Check this box. And when you hit continue, Um, right, okay, then it says here you'll hit continue. There's the rest of the explanation here. And then it takes you here where we're going to say tax on early distribution. And we're going to go into here. So this screen right here will say early distributions that aren't subject to the 10% tax. In other words, we've now we've asked this taxpayer, well, hey, why did you take this money out? And they may tell you a lot of reasons for it. Hey, I had to go to school. Hey, I lost my job and I had to pay for it. I had to I bought a home, right? And had to make a huge down payment, and that's the only money I had to make the down payment from, right? They'll tell you those things, and then you want to go look, see where it says down here, select the reason for exemption. And by the way, those reasons are in your 4012, right? So this says, look at the drop-down menu on the next slide. Here are all the reasons that would exempt you from that 10% penalty. I'm not going to read all of these to you because most of them are fairly rare. Okay. But if you have medical expenses, now there has to be huge medical expenses. Okay. Has to exceed 7.5% of your adjusted gross income. That's rare that we're going to ever see that one. But higher education purposes, that's common. They go back to school and they take money out of their, especially if they lost their job and they're going to go back to school to retrain a career. Well, they can take money out of their IRA to pay for that. They'll have to pay taxes on the distribution unless it's a Roth, okay? But they won't have to pay that 10% penalty. Or first-time home purchase is common. There's two that came into being last year, okay, that are new. And by the way, your test question has one of these on here, so I'm going to give you a clue about that too. Look at these two down here. Qualified distributions to victims of domestic abuse. That could be kind of uncomfortable when you're talking to them, but if they said they had to take out money and you kind of ask them why, and they kind of hedge and they were saying, well, we were having problems with my spouse. You probably don't want to ask them, hey, are you a victim of domestic abuse, but you might want to at least let them know that there is an exception to the penalty for you know uh, spouses who are victims of it doesn't have to be a spouse either. I mean, victim of domestic abuse, right? But a more common one here is distributions for eligible emergency expense distributions. Now, and you might say, well, what classifies as an emergency? Okay, and your 4012 does have a few items in there, but I will warn you, the test question is a little bit more difficult. In the 4012, it tells you to see a more comprehensive explanation of examples, go look at this notice. So pull up your 4012 and look in there, and there's a notice, an IRS notice. If you use the PDF of the 4012, I think it's a live link that'll take you to the notice. And you should read that, especially for this test question. Okay. So here was what we were talking about, emergency expenses. Um, some of them are pretty obvious. Hey, I had to pay my rent. I had to pay the utilities that are going to shut off my lights. I had to fix my, I can't think of other things, but you get the idea. Um, Again, survivors of domestic abuse can take out a chunk of money out of there, right? It's limited to 50% of the account. And again, they may have to pay tax on it, but they won't have to pay the 10% early withdrawal penalty. And oh, here's a little note here. The taxpayer can self-certify that the abuse has occurred. Same thing with the emergency expenses. We don't need to see receipts for them. I would tell them, if they're claiming that, make sure they document something in case they get audited, right? But we take them at their word. There's another one for terminal illness if you're expected to result in death in 7 years. Okay, so here is a copy of a 1099-R. And so let's look at what some of this stuff says. Okay. First of all, box 1 tells you that there's a gross distribution, 17,500. 2A says taxable amount, and there's nothing in there because in 2B they mark this box that says, hey, taxable amount is not determined. Okay. Now, in this case, I don't know why they would say that, but quite often, banks and investment companies like Vanguard and Fidelity and all these, they sometimes get rollovers of IRAs. They don't really know the whole history. So sometimes almost by default, unless you established it with that, establish the IRA in the account with that investment broker, and they know exactly what the history is, they're not going to take a chance about guessing what was taxable and what was not. They just click this. So it's up to you to figure out. Now, in this case, I go down here and I say, hey, there's a distribution code of G. What is G? And again, I told you I can turn that 1099-R over and get my magnifying glass out, or I can go into the Pub 4012. And if I do go into Pub 4012, as I said, I think it's like on page D 47 or 67. You can just look for the codes in the index. It'll tell you where it is. And G is going to say it was a direct rollover of an IRA. Okay, I would thought, gee, well, they'd know as long as it's a direct rollover. Now, what is a direct rollover? There's two types of rollovers. Okay, a direct rollover, and always recommend people do this. Okay, direct rollover is where it goes from one institution to another. Like in this case, here I had it with IRA Bank, and I wanted to transfer it to Vanguard. But I tell IRA Bank, hey, you send the money to Vanguard. I don't want to touch it. Okay, that's called a direct rollover. As opposed to if they send me a check, then I've got 60 days to go put it into another IRA. And I'll show you how we handle that in TaxSlayer in a second. Always watch to see if there's federal income tax withheld, because if they had sent me a check, they're required to withhold 20%. Now, if they do a direct rollover, they're not required to withhold any money. And see right here, this, gee, they didn't withhold anything. I don't know why they wouldn't fill this in, except for they may not know the whole history of this account. Maybe there is, maybe they had made some kinds of after-tax contributions to the account. Maybe not, maybe it's not 100% taxable. We're going to show you an example of that in a minute. So here's the screen in TaxSlayer. When you go in here, you can say here's the gross distribution, taxable amount. Check this box, says taxable amount to determine. Remember, if you see it, key it. We want to replicate that 1099-R exactly. Now, if for some reason they had sent you a check and the client tells you, hey, yeah, I went and established this rollover right away, before 60 days, you're going to go check this box right here. It says check if all or part of the distribution was rolled over, and then enter in the rollover amount, right? That way we make sure TaxSlayer doesn't try to tax them on that. Here's the screen, or I'm sorry, here's the page in tab D of the 4012 that gives you all those codes. And I would get used to going and looking at this because, well, you can see here, and I'm not going to try to make you read this, right? But you can see this is just box 7 distribution codes. There's a lot of them. And if you look at some of these, a lot of these are out of scope. So you at least want to make sure you're doing a return that's within scope. And then you might want to read some of the things here, right? Just to make sure you're entering it, perhaps. Okay, so here we have generally the general rule is when you've got an IRA, a pension, or an annuity. Hey, what's an annuity? An annuity is an investment product, usually that you buy from an insurance company. You give them a chunk of money, and then you say, hey, when I retire, I want you to then pay me a monthly amount for as long as I live. And there are 100 variations of these annuities, right? But I was just giving you the general form. It's one way that people can ensure that they don't outlive their money, they give it to the life insurance company, and then the life insurance company they go by tables to figure out how long on average you're going to live, and they calculate your distribution based on that. But so the general rule is all of these things are fully taxable. However, okay, if you put in some money into the plan with after-tax dollars, like for instance, you buy an annuity with money that you've already paid tax on, then really when those payments come out, only a portion of it's taxable. They're only taxing you on the earnings. Or earlier I described a Roth one where you take out an early distribution before 59 and a half. Well, some of the money is going to come out as the money you put in and you already paid tax on, but then some of the money is the earnings on it too that you have to pay tax on. So here's where it gets a little complicated, but I'm going to show you how to make it simple, okay? So it's partially taxable if they've contributed after tax to, this is called the cost in the plan. Just kind of get used to that terminology because it's used in your text questions and test questions and stuff, okay? So basically what this is saying is that the money you've already paid tax on, they're not going to tax you twice on it, right? That money gets to come out. You only pay tax on the earnings. Here's the problem, is they don't return your money first and then start taxing you on the earnings. They prorate it along your lifespan. And that's where the calculation gets kind of complicated. Okay. So here's a really note about disability income. And this would, in that 1099-R, I think that's box 3. And it'll say here that if you get disability income before retirement age, it's taxed as wages. But then if you get disability after your minimum retirement age, it's taxed as a pension. Now, why would that matter? And I have to take you back to our first discussion on income, where I described those two buckets about earned income and unearned income. So if that's before retirement age, this would be earned income. And especially if they've gone on disability, they may not be getting a lot of money. They might be entitled to an earned income tax credit. So that's kind of why that's important. So now we're going to talk about what if, some of the money was put in after tax. And here it's saying, well, we don't know how much is taxable. We don't know, we say taxable amount not determined, right? Well, there's two ways. The first way I'm going to show you is within TaxSlayer, but you've got to have a lot of information to be able to do it. Now, luckily, you're going to have to do one of these for one of your test returns, okay? But they give you all the information you need to do it, okay? How do you access the worksheet to do that? In TaxSlayer, when you go to put that 1099-R in here, actually, be careful of this. When you put in this amount here, it populates this amount with taxable amount. Always watch that, because if the form says 0, you want to wipe that out. And when you wipe that out, you see this box here. It'll say, hey, do you need to calculate your taxable amount? Okay, because if it says taxable amount not determined, you click here for options. So here's the information that you need, especially at least within TaxSlayer, right? Is you need the gross distribution amount, the cost in the plan. Now, what that means is what your contributions were, okay, after tax contributions, okay? When did the annuity start? And sometimes you can find this on the last year's return, but often you just got to use a good interview. I'm going to show you another tool that hopefully if they come back year after year, we'll have that information. But, and this can be awkward because, you get somebody who's been in retirement for 10 years. Well, geez, you need to know the month and date, month and year it started. Well, yeah, I think it was, 19, well, was it like 2005? I don't know, June maybe. This is you got to pull it out of them sometimes, right? Always go look at their last year tax return because there may be a worksheet in there that tells you that. You also have to know whether it's a single life or multiple life. This is called joint and survivor annuity, because sometimes the annuity is based on just your life or yours and your partner's life. In other words, like after one of you dies, it continues to pay the other one a certain amount. Of course, usually the payments are lower then because it's spread out over 2 lives then, okay? Then you need to know the age of on the date the annuity began, and also if the spouse's age, if it was a survivor. And then, see, here's where it gets a little bit complicated. In TaxSlayer, you need to know the amounts previously recovered, meaning they put in contributions, and now every year a portion of it's taxable. So the portion that is not taxable is a recovering of their taxable their after-tax contributions. Does that make sense? Okay. In other words, they're getting a portion of their own money back that they've already paid tax. Now, TaxSlayer says, well, we need to know how many, years that they've recovered this. Now, I'm going to show you another tool that you don't really need to know that, and it'll give you a worksheet for calculating it. And then you have to know the number of months paid in previous years. Actually, the only time this is really important is if it's in the first year. Okay, so here's this other tool. I'll tell you what, before I go into the other tool, let's stop right here and go into TaxSlayer, into Practice Lab, and show you how we enter in a 1099-R. Okay, so let me stop sharing my screen, and I'm going to have to go into Practice Lab here. Okay, so I'm going to go to the practice area. Now, the other thing that I want to show you is what are the documents that I'm going to use, okay? I'm going to go into this return we've been playing with, right? But I'm going to use the 2024 stuff so that at least I'm using old information to just show you how to do this. Okay, I'm in the right one now. So we're going to use Advanced Scenario 7. Again, remember, this is not the current year, okay? But this scenario is very similar. It's got a similar thing. It's just different data and different amounts. But this way, I can show you how we're doing it. Now, the relevant part of this is it says here, Faith retired in 2021 and began receiving her pension on November 1st of that year. Remember, we need to know the month and year that she retired. So this was 11/21. She explains that this is a joint and survivor annuity. That's another thing we needed to know. And then she's already recovered $1,259 of the cost of the plan. Okay, so let's go down and look at her 1099-R. And by the way, and I may make some of this up, but you'd also need to know her birth date from the interview sheet. Okay. Let's go look at the 1099-R, which is right here. Let's see if I can make this bigger for you. There we go. Okay. So she got a gross distribution of $20,100. Okay. It says no taxable amount, but the taxable amount is not determined. They withheld federal income tax, distribution code 7, but look here in 9B. This right here tells you where it says total employee contributions, 15,000. That right there tells you that this is not likely to be 100% taxable because she gets to recover part of her after-tax contributions. So this is the data that we need to go in here. Now I'm going to go into this return and I'm going to put in a 1099-R based, whoops, hold on, I got to stop sharing here and share the tax return. Okay, so I'm going to go into this kind of this play return that we have here. And I go click on federal and section, and here's income that comes up. Remember, here's 1099-R RRBSSA. This is what we're talking about here. So I'm going to say begin. And here's, I showed these in your presentation, what the choices would be. We're going to add or edit a 1099-R. Okay. You can go look, the 1099-R would tell you whether it was substitute or corrected. Most of the time, just standard R. Who is this? I'm going to say it's the taxpayer, right? I'm going to put in here, remember, this is a different taxpayer than the one. I'm going to put in here that 20,100. Remember when I click on there, see, I warned you, it populates that automatically. Then in ours, it was 0. But now I can say here, do you need to use the simplified worksheet to calculate your taxable income? So I'm going to say yes, click here, okay? And we're always going to use the simplified method worksheet. We're not anyway, just enough of that. Okay. Now it's going to tell you when you have to use this. For almost all of our cases, you're always going to use a simplified method. Okay. So we're going to say we're eligible to this and hit continue below. Okay. Now here's the first plan cost at annuity start date. What's the plan cost? See, it's this language that kind of trips you up. But remember, I told you that was the employee contributions. And in this case, that was $15,000. What was the start date of the annuity? Well, that was 11/01/2021. Okay. There was no death benefit exclusion. Okay. Check here if the annuity benefits are based on the life of the annuitant and beneficiary. Okay. Now, in this case, uh, 2 years ago, one of our other, in fact, I told you about the instructor who created a lot of these slides, Gene. He wrote to TaxSlayer and said, look, you guys know their birth dates. Why are you making us go calculate this, right? And messing up a calculation maybe because, well, were they born in November, but before the annuity start date and all this? And so they finally figured out, yeah, we can program this. So it's counted the combined age at the annuitant start date. Okay. Number of months paid in 2025. Now, the only time that wouldn't be 12, there's two times, sorry, was the year they started. Like if this was 2021 and they started in November, we put in 2 here because they only got November and December. Or maybe the year they died, right? And they only collected it for 6 months, right? In this case, it's almost always going to be 12. Now, the amounts previously recovered, they told us what that was in the fact pattern. I'm going to show you another tool where you don't really need to know that. But for right now, let's do it this way. And I just went back and looked, and it said they had already recovered $1,259. So here I'm going to put in $1,259. Okay. And there's no qualified charitable distribution, so I'm going to hit continue right here. So right now it says the taxable amount is $19,519. See, they got $20,100, but it looks like they're not having to pay tax on $500 or $619, something like that of it, right? They're recovering the portion that they've already paid tax on, and they're going to get this every year. So now I'm going to hit continue. Okay. So now you get an idea. This was how you be able to calculate this. And by the way, once I get there here, it's put in this taxable amount for me. Okay. So I don't have to go change that. Okay. Let me stop sharing this and go back into my presentation here. Okay. And then right here, I'm going to show you this other thing that says Colorado Resource Toolbox. Now, this puts in a little extra work for you, but if you do this, it's going to save work in subsequent years. A lot of work. You won't have to go in and use that tool every year. And plus, you don't really have to, if you're sitting in real life with a real taxpayer and you ask them, well, how much have you already recovered of these after tax? And they're going to say, huh? What do you mean? You're either going to have to go calculate it or I'm not sure what, but here's a tool to where you don't really need that, and I'll show you why. So how do you get to this thing? If you just Google Colorado tax aid or Colorado pension calculator, you'll be able to find this tool pretty easy. It's a very common tool. It's a guy named Jeff Bogart used to work with AARP, and he's put together a lot of these tools. There's even more of these. There's this calculator, business activity codes. I'm going to scroll down here. I found this one to be very helpful, the education benefits calculator. Sometimes we have to search for employer identification numbers, and this isn't 100% complete, but it can be helpful. So this is a good site to get familiar with. So I'm going to stop sharing this and I'm going to go in and create, go ahead and create for you. Hang on here, right there. I'm going to go look for this, right? So uh, in here, I'm going to put Colorado tax aid, AIDE. Oh, and there it comes right up. Colorado tax aid pension calculator. So it comes right up here, annuity pension exclusion calculator, Colorado tax resources. Make sure you're going to the right place here because there's lots of other places that have done this. But when I go up and click on this, okay, it takes me right into the calculator. It might be better if I showed you how to start from it. If I start from the toolbox itself right here, that's what I showed you on the thing here, then I can click on the calculator and it takes me to this. So I'll just type in here test. I'm going to use the information that we used from uh, our other thing here. So there's some questions here. Oh, by the way, which year are you doing this for? So if you're doing it for a prior year, you can do it. Annuity start date was 11/01/2021. Okay. Annuitant's birth date. So I do got to know that, and I'm going to go back into that intake and interview sheet. And she was born, oh no, Vincent was born. Faith was born on October 8th, 1955. Okay, 10/08/1955. Okay, so she's 66. It just calculated that. The spouse, he was born on 05/01/64. So he's 57. Okay, again, now see it now, it calculated 123 as their joint thing. Um, Combined age for joint or survivor, annuitant's birth date. I thought I had to check somewhere that it was. Okay, well, I guess not. Gross distribution was 20,100. Okay. And then now if I click here to calculate, oh, I guess I do need to know the after-tax contributions. Yeah, okay. Of course I need to know that. And that was right on the 1099-R. It was 15,000, right? Okay. So now I click to calculate. Now look what it's done for me here. Okay. It's showing me that, hey, this is the same thing we just came up with a minute ago from TaxSlayer, was 19,519 is taxable, right? Um, But then look what it does here. It gives me a table for every year. Like her first year, she only got to exclude $97 because she only had it for 2 months, right? Then every year it's going to be the same 581 except for the last year. So what we do here, and then you can print this table out right here. You can say print the table, okay? And we put this in their envelope with their return so that when they come back next year, we say bring this back next year, then next year, all we have to do is, take their distribution, 20,100, subtract 581 from it, and put that in the taxable amount in the TaxSlayer input screen for the 1099-R. We don't have to go through all that rigmarole about calculating it. We've got it right there in front of us. So this is a really handy tool to use. Okay, let me stop sharing this and go back into our presentation. So that was the TaxSlayer tool that I just showed you. All right, good. Now, here's another thing. We highly recommend this. Yeah, we tell them, we print out that table and we have put it in their envelope. We say, bring back the envelope. But half the time, maybe not half the time, but often, oh, well, I don't remember where I put that, or I don't know, and they forgot it, whatever, they didn't bring it. So go in and put a note in the tax return that tells next year's preparer the date of retirement, the annual exclusion amount, the final year, and the partial exclusion for that year. Okay. So that way, when we pull up the return next year, that note will be there and we know right away how to handle it. Okay. So that was retirement income for the federal return. Now for the Arizona return, I'm going to go over a couple of things. Maybe if you're from a different state and you're watching this, go look at your state rules because they may have similar rules. A lot of states do do it. For Arizona, you can get a $2,500 per person pension exclusion. And either spouse who qualifies is entitled to it. Unless the pension amount is less than 2,500, then you only get to exclude the amount of the pension, right? But here's the key. Enter the exclusion amount if the 1099-R is from a U.S. government retirement, as Arizona state retirement. It's basically Arizona public retirements. Okay. Now, if you're in Arizona and you're filing an Arizona return and you moved here from Illinois 5 years ago and you're getting, you were a teacher there and you're getting a state Illinois pension, that doesn't count. Has to be Arizona pension, right? And here's the second one, is that they're part of the uniformed services. Any one of these services right here, 100% of their pension is excluded. Okay. Here's where you would go do that in the Arizona return. This is after, in TaxSlayer, after you do the federal, you go into the Arizona. You can go into here for subtractions from income. And usually when you enter the Arizona, if you've entered in a pension before, it's going to warn you, hey, do they qualify for this? I would say yes. And then it comes into this screen, subtractions from income. And here I can put, this is for the exclusion for U.S. government or Arizona state or local government pensions. One for the taxpayer, one for the spouse, if they both receive a pension, right? If it's only the taxpayer, they only get the exclusion here. Here's the one for uniform services. So there's that. Now, here's another wrinkle that will happen. Let me get a drink. What if they only have Social Security or other tax-exempt income? Remember, I told you, if Social Security is their only income, they don't have to pay tax on it. So, and yet I told you we encourage them to come and have their returns done. If Social Security is their only income, they're going to get a property tax or a renter's tax credit, plus they're going to get a $25 kind of like refund of their sales taxes, right? But more importantly, it protects their identity, so nobody can file a return using their Social Security number. However, if it comes up with zero AGI, like if all they've got is Social Security, it's not taxable. TaxSlayer will reject it. It won't let, the IRS rejects a return with zero AGI. So we have to go fake it out. We have to go in there and put in other income. We have to enter $2 as other income and say this is for e-filing purposes. Doesn't affect their taxes or anything like that because their standard deduction wipes it out. But then it allows the computers at IRS to accept the return. So we just go in here to income. We scroll down to other income. We put in here other income not reported elsewhere. We type in for e-filing purposes, type in $2 and hit continue. Okay. So that gets us through retirement income. Now I would like to tackle a little bit of other types of income and then we'll cut this short and pick it up in the second session of session 3. Okay. Let's look at capital gains and losses. Okay. As I said at the beginning of income, all belongings or property you own is, well, as I said, no, this isn't what I said. Forget that. This is definitely, generally all belongings or property that you own is considered a capital asset. This is true whether it's used for business use or personal use. So this would include your home, investments in stocks or bonds, any property that you own. Your car is a capital asset, right? Those things. Generally, there's stocks and bonds or homes, right? Those are for personal things. Those are generally what we call capital assets, right? And in VITA, we can handle the sale of stocks, mutual funds, even the principal residence. These are all in scope for us, right? Now, here's the first thing that you need to know about capital gains is the timing of it. There's two buckets, if you will. One, there's short term, and one, there's long term. And it's pretty easy. First of all, if you put in the dates that they were bought and sold, TaxSlayer is going to calculate this all for you, right? But you should understand the implications of it. So short term is where they hold the asset for 1 year or less. Long term is if they hold it for more than 1 year. Now, the reason that makes a difference is because any gain or loss for short-term assets are taxed at ordinary tax rates, and long-term gains or losses are taxed at capital gains rates, which are lower than ordinary tax rates. That's why this is an important aspect of it. So here's what you have to have when you've got a stock transaction. And when I say stock, it could be mutual funds. Those are what we see a lot in here. You got to know the purchase and date of sale. You got to know the basis of stock. What is the basis? In simple forms, it's what did you buy it for? Plus, there could be increases in the basis. And often this happens like with mutual funds. When they elect to say, well, reinvest my dividends and capital gains every year, the fund will pay out dividends and capital gains. And the taxpayer could either elect to receive those in cash, or more often than not, almost always, they say, no, just buy more of the fund. And if they buy more of the fund, that increases their basis in the fund because it's like they bought more, right? Then you also need to know the proceeds from the sale. You have to know any previous capital loss carryovers. We're going to get into that in a minute, okay, what that is. But the key here is if they've got capital loss carryover, you need to see their prior year return because that's the only place you're going to get the accurate carryover. Because they may have had losses that they couldn't use in previous year, and they get to carry them over into this year. Okay, so now there's another two buckets that I want to tell you about. Okay, we already talked about the long-term and short-term buckets, right? Now we've got two other buckets where, remember, I described what the basis meant, right? Generally, it's what you paid for the stock, okay? And on these forms that are going to be given to us, there's going to be little boxes checked, and the boxes will say, hey, was the basis reported to IRS or was it not reported to IRS? So we have to know those two. So all of these transactions are going to fall into one of these four boxes. It's either going to be long-term where the basis was reported or not reported, or it's short-term where the basis was reported or not reported. When we print out the tax return, we're going to see these other forms that each form will relate to each bucket if they had multiple transactions and did all of this, okay? So here's a form. This is called a 1099-B, proceeds from broker and barter transactions. They'll come looking like different ways, but they all have, see, these are like those boxes I keep telling you about, 1B, 1C, 1E, 1F, right? But here, now it's saying they've got the Magic Investor Class Fund, the Hot Air Bond Fund. Now I can enter in all of these transactions individually because I need to know what did they sell, when was the date acquired, when was it disposed of, meaning when did they sell it, here's when they bought it, here's when they sold it, right? TaxSlayer will calculate, okay, no. Proceeds means what did they sell it for? What did they get for it? And then here's your basis, right? And again, there's going to be a little box up here. What does it say here? 1A description to a, this really doesn't, oh yeah, here it is. Short-term transactions for which basis is reported to the IRS, right? So we need to know that, okay? And then sometimes we'll talk about these adjustments in a minute. But here's what I wanted to say is when you get these forms, when it comes from one brokerage, maybe there were multiple sales in here, we can just enter in the totals, right here for each one. Okay. And actually, we could enter in the totals for each of those buckets, right? Long-term basis reported, long-term basis not reported. This form may have multiple transactions on it. Usually the ones we see are much simpler, right? But all I'm really trying to say is that um, you don't have to enter them individually, but you have to segregate them by those four boxes. Long-term basis reported, long-term basis not reported, short-term basis reported, short-term basis not reported. And also, you can't combine different brokerage statements. You can combine them all on one brokerage statement, right? But okay. This is showing you where there are adjustments, if any are necessary. So I'll go back up here. See box 1G, it says here there was an adjustment of 226.80. And then there's a code, W. So down here in TaxSlayer, we can put in that adjustment and then we check that it's a W. Almost any of these other codes are going to be out of scope for us, and you rarely see them, but you will see these. This is for a wash sale. And what a wash sale is like sometimes we get to the end of the year and the broker will call you up and say, hey, you've got these things, you've got a bunch of losses in this one. Why don't we go, and you've got gains in this other one. If we sell the one with the losses, we can offset the gains in this other one. And, and then your broker might tell you, but hey, man, this is really a good stock. There's nothing wrong with this stock. It's going to come back up. And so you may decide that then after the first of the year, you go back in and buy it again. Well, you've got to wait. I think it's 60 days. It could be 90, but you've got to wait a period of time before you buy back into the stock, or otherwise it's called a wash sale. And then the loss gets deferred. Like in this case, $226 of loss gets deferred until you sell it subsequently. Then it's there. Probably more information than you wanted to know, but I thought I'd give you an explanation. Okay. As I had told you earlier, when we first looked at 1099 interest and dividend, you often get a combined statement that combines all of these into one, especially if it's all at one brokerage firm. Right. So here's an example. Here they did dividends. Here they did miscellaneous income. See, 2020 1099 miscellaneous. We probably would never, these would be out of scope anyway. But down here, here's summary of proceeds and gains and adjustments, where these are stock sales. So we could see here it says short-term basis reported to IRS, proceeds, cost basis. See, we could enter that as one transaction and then enter this one, short-term, where the basis was not reported. Well, these are all zeros, so I wouldn't do that. But anyway, you get the idea. So let me stop sharing here and go back into our tax return. I'll go back into the income screen over here. And you've got to look for this here too. Because down here, you've got to know which schedule it goes on. Schedule D form 8949, or just read here. Capital gains and losses reported on Schedule D. So I'm going to click on here. If I look at my, there was one of the scenarios last year in 2024 that had stock sales. If you'll let me find it real quick. And anyway, it really doesn't matter. I'm going to just make one up so I can show you how to input it here, okay? So here we're going to go in. There's several things on here, right? We're going to use this one, stocks, mutual funds, cryptocurrency. We can never do cryptocurrency, but as again, TaxSlayer handles it. We're just not allowed to do it. This comes from Form 1099B or broker statements. That's what we're looking for here. But then I also mentioned about capital loss carryovers. You would go in this screen to enter in any carryover as well. So let's start here. We'll say that this is from the taxpayer. We're going to say that he sold 10 shares of Microsoft. Okay. Okay. What was his date acquired? Okay. Now, here's the thing is that sometimes, in fact, often, and in fact, I showed you that brokerage statement where they had several transactions, right? And I said, well, you just really need to enter in the totals, right? So they had sold different buckets of that, different lots of that stock at different dates during the year. So since I don't really know, if I don't have this box checked, I can only put in one date and it's required. But I could say alternate option, and then I could say various. Now I got to know whether it's short term or long term. And I had skipped this part in the presentation. But if they inherited a stock, it's always considered long term. Okay. We hardly ever see any of that, but it could be. Okay. So in this case, I'm going to say that this was various short term. Okay. When was it sold? Now, there's an alternate application thing that could say, but it only gives us worthless and bankrupt, right? That doesn't apply to us here. So in this case, even though we had multiple different sale dates, I'm just going to put here the end of the year, 12/31/25. Okay, sale price, I'm going to say here we got $5,000 for it, right? Select, this is important right here, select the cost basis type, right? Um, was the basis reported? Was it not reported? Did you not receive 1099-B? None of these others. Okay, oh, you know what these are for? Is digital assets. And we're supposed to start seeing these. I forget if it's 2025 or 2026. I'm thinking it's 2026. But first of all, remember if it's digital assets, it's out of scope. So you're not going to need to worry about this. This just caught my eye right here. What's important, we need to know whether the basis was reported or not reported. In this case, I'm going to say the basis was reported. Okay? Cost. Meaning this is basis, right? And I'm going to say, well, I bought this stock for $1,000, right? Um, well, that'd be a hell of a gain in 1 year, but it doesn't matter. Here's the adjustment screen. I'm not going to put in an adjustment, but as I said, almost all of these are out of scope except for wash sale. There's where I would put that in. So I'll hit continue here. And hit continue, continue. What I want to show you here is I'm going to go in here and print the return. I'll make it bigger here so you can see. What I want to show you is if I go down through this return, it creates a Schedule D. Creates a Schedule D. So you can see here's this one that I did, and this doesn't hardly make sense for you. It says totals for all transactions reported on Form 8949. That's what we're going to go look at in a second. With box A or G checked in you, huh? What does that mean? Don't worry about it. TaxSlayer handles this, right? But they aggregate all of these forms into one. This is kind of like the summary of all their capital gains and losses, right? Whether they were short term or long term, which box was checked, blah, blah, blah. If you had a carryover, and it could be a long-term loss carryover or a short-term loss carryover, you got to know it keeps its character that way. It would know that. Oh, also, look here, capital gain distributions. Remember when I entered in that 1099 DIV and it had that, I think it was box 3 that had capital gain distributions? Those get reported right here. Okay. But what I wanted to show you is here for every one of those 4 boxes, it's going to generate an 8949. This one says these are short-term transactions that the basis was reported. Okay. If we had transactions that weren't reported, it would generate a different 8949. And it would also, then down under here, oh, it doesn't show it here, but the next page would have the long term things as well. And here it would list all the different transactions that do it. Okay. So we'll stop sharing that. Let's go back into our presentation. Okay. So these were there. Okay. Homes. Well, not yet to homes. Hang on. Capital losses on personal property such as vehicles and homes are not deductible. I don't know how many of you might remember the 2008 collapse of the housing market where people were selling their homes for less than they paid for them. Unfortunately, they didn't get to deduct losses for those. Losses on personal assets are not deductible. However, gains might be taxable. You know, I mentioned what is a capital asset? Like say you go out and you buy this 66 Mustang, right? And you keep it for several years, you go fix it up, you restore it. You bought it for 5,000. That's your original cost. Maybe you put $3,000 of improvements for it. That would increase your basis. So now you've got an $8,000 basis, but then you go sell it for 10,000. Okay? Your gain is 10,000 proceeds minus the 8,000 basis, and that's a personal gain. You still have to pay taxes on it. On the other hand, if the market for Mustangs crashed and you could only get 6,000 for the car, you had a $2,000 loss and you don't get to use the loss. So bummer. But okay. So now what if you have losses that exceed your gains? You get all done and you remember we've got two buckets that are short-term and long-term, right? And you go total it. And by the way, don't get a headache over this because TaxSlayer counts it. As long as you check those boxes right, whether it's short-term or long-term, basis reported, not reported, it's gonna calculate this for you. But it then goes and calculates all of your long-term gains or losses, and it offsets the losses to the gains. Maybe you've got more losses. Then it looks at short-term gains or losses, and then it nets those two. And if you end up with a loss, right, you can deduct up to $3,000 of that loss against other income. Okay, let me back up just a little bit. You can always deduct capital losses against capital gains. Okay, you can always do that, no matter what the amount is, right? But if the losses exceed the gains, you can only deduct $3,000 a year off of other income, like say your wages, right? Okay, so now if your losses are more than this limit, here's where you get the carryover. You get to carry over those losses to later years. Maybe you had really bad luck and you lost $15,000 in the stock market. Well, you get to use $3,000 this year to offset your wages or interest and dividends or whatever, okay? Meaning you get a deduction for $3,000. Then the other $12,000 you get to carry forward to the next year. And if you don't have enough gains to offset those 12,000 losses, you get to use 3,000 more to deduct that until it's all used up. That's that capital, that carry forward we were talking about. So to enter in the carry forward, remember I say we go into capital gains and losses, we go into other capital gains data, and then we enter in, remember I told you, the prior year tax return is going to tell you what the short-term loss carryover is and what the long-term loss carryover is. Okay, they keep those separate. Okay, now Arizona has a specific thing here that says for capital gains from assets acquired after December 31st, 2011, which is starting to be most things. I mean, that's 14 years ago, right? Most things if you're doing it. So most of these things will qualify for this, right? They get a separate deduction on the Arizona return of 25%. The reason for that, the general reason, is Arizona doesn't have two different tax rates like the federal government does, right? Federal government has regular tax rates and then capital gains rates. Arizona's got one tax rate. So this is their way of giving a benefit to capital gains. And if you're in another state, you should check and make sure that what they're doing here. Okay. Okay. There's really not much else I want to tell about that. Um, okay, so here's a couple of examples we'll just run through real quick, and we're getting to where we're going to come to the end of this first half of session 3. But right here, let's look at this. In 2007, Zach bought 100 shares of Atoka for $3,000. In 2012, he bought another 100 shares of Atoka for $3,300. In 2025, Zach sold 100 shares of Atoka for $4,000. He did not specify the specific block at the time of sale. So here's another oddity. IRS allows you to pick whether you can sell the first ones or the last ones, or you average it. And you tell your broker whether you want that. If you don't make any decision, they're going to take first in, first out, meaning that he bought the first 100 shares in 2007. If he sold 100 shares in 2025, they're going to use this 100 shares, right? So what is his now? And we know it's long term because it went from 2007 to 2012. So what's his loss or gain in this case? It was a gain. He sold it for 4,000. He bought the 100 shares for 3,000. So he had a gain of 1,000. Okay. Few things about the main home, sale of main home. Okay. And you may have clients coming in and say, well, yeah, I sold my main home, but I purchased another one for more than I sold that one for. Well, these are folks, they're usually older in nature, and they're remembering back before the Reagan Tax Act, where it used to be you never had to pay capital gains as long as if you sold a home that had a capital gain, as long as you purchased another one for at least the same amount. That rule went away in 1986, but there's still some people who remember it. Okay, so I thought I'd tell you about that. In 86, this got replaced with a rule that says that you can exclude a chunk of your capital gains, whatever it is, as long as you meet two tests, an ownership test and the use test. And what this means is that during the 5-year period ending on the date of sale, you sell your house, okay, you had to have owned the home for at least 2 years, and you had to live in the home as your main home for at least 2 of the last 5 years. Okay, that's the test. And if that happens, you can exclude up to $250,000 in gain from the sale if you're single, and $500,000 if you're married filing joint. If you can exclude all of the gain, you don't need to even report the sale unless you receive this Form 1099-S. Often what happens is during closing, the title company will ask you questions about how long have you owned the home, they'll determine whether they've got to send you a 1099-S. Now, they may send you one anyway, and if they do, that means they reported it to the IRS. Now, if the sale of the house was less than $250,000 or $500,000 if you're married, don't bother. I mean, even if your basis was zero, you don't have a gain. But if you bought the house for $300,000, you sold it for $500,000, and you get a 1099, you might well go ahead and report it. Okay, even though you're not going to pay any taxes on it. You report it on Schedule D, and remember, you can't deduct a loss, so don't try. Okay. So in this case, Emily sold her home in June of 2025. She recognized a gain from the sale. Oh, hey, this gets a little complicated. She married Jamie later in the year. So she married Jamie, but later in 2025? So Emily meets the ownership and use test. Which of the following is true? Okay. Do they qualify to claim the gain as an exclusion? Can Emily exclude 250,000 gain on a separate or joint return? Emily and Jamie, they're married now. Can they exclude 500,000 gain if they file? Or is the answer none of the above? So how would you apply those rules that I just told you about? Put it on pause and think about it. And if you want to, go back and look in the 4012, it'll tell you. She can exclude up to $250,000 because when she sold it, she was single. And it doesn't matter whether she files a separate or joint return, but she can exclude $250,000 a gain. Here's the screens where you would put in that. You'd put in the date of purchase, purchase price, sales price. Now, I think on this screen, yeah, on the subsequent screens, it's going to ask you about how many days you've lived into it. I believe it asks you, yeah, here we go. Examples of improvements that increase your basis, because there's a part of this form that's going to ask you about improvements. So let's say you bought it for $250,000 and then you add on a bedroom, okay? That increases your basis, okay? Anything that extends the life of the home or is a major improvement counts towards your basis, but maintenance does not. If you're just maintaining stuff, it doesn't. But here are things that would increase your basis. You put on an addition. You put in new landscaping, like you plant a tree or build a fence. You put in new roofs or windows or doors or insulation. You put in an air conditioner. All of those things increase. You put in new plumbing. Now, if you just repair something, that doesn't count, right? But if you put in something new, like a new water heater, that increases your basis. Or you remodel, the bathroom or something like that, put in carpeting, that counts. Maintenance does not count, okay? So what are some examples of improvements you can't include? Cost of repairs or maintenance to keep your home in good condition, but don't prolong its life, like painting, fixing leaks, filling holes or cracks, replacing broken hardware. You get the idea. Usually we don't have to work this hard at it. Okay, people buy and sell their homes, and usually that exclusion covers all of their gain, especially with our clients. Okay. Okay. So here was how you would put in that on a main home. There is a code for an adjustment, a code H. So if there was a gain, we put in this code H and it adjusts the gain. Okay, so with that, I am going to stop right here. We've done enough for today. We will come back in session 3B and pick up with K1 earnings and unemployment and other types of earnings, and then also talk about adjustments. So until then, I will see you then. Okay, bye-bye and take care.